Hello, my name is John Kornacki. I'm a financial strategist here at the Federal Home Loan Bank of Boston. Thank you for joining us today for another edition of our case study series, this one titled Residential Mortgage Keep Sell Analysis. Today we're going to walk through some of the challenges institutions are facing right now and where we see opportunities to protect against margin pressure as well as optimize cash levels. There have been tremendous shifts within the balance sheet over the last 2 quarters, and whether that is coming from asset shifts, with loan composition changes or investments, or from the liability side with the surge in deposits that many of our members have seen. And with that, those shifts continue to put pressure on margins and increase asset sensitivity across our membership. So there are things to discuss here with those dynamics. And then lastly, with the unbelievable mortgage boom our members are experiencing, there's a lot of opportunities here to address some strategies that can combat short-term and longer-term balance sheet and income statement challenges. We can start off by looking at a few trends over the last quarter. Based on the call report information that we've analyzed, these three trends are what most of our membership saw over the last quarter. You have tightening net interest margin, which, with the drop in short-term rates, members saw significant loan prepayments and repricing, and that was consistent with our banks and credit unions. CFOs right now are trying to find ways to slow that down, whether it be from aggressive deposit pricing or in some cases reaching for yield outside of their comfort zone. You also see significant decreases in loan to deposit ratios. Our credit union members saw a steeper decline, but overall it's significant across all of our members. And this was largely driven by asset prepayments, slowed loan growth, and along with the unbelievable deposit surge. So this has led to significant liquidity levels, a smaller loan book, and frankly, folks looking for ways to deploy cash. And then the last piece here is mortgage sale income, which is a data point that we can get from banks, but I imagine credit unions have a similar trend based on the conversations that we've had. The common theme with our members is that gains on sale have been so high that origination volume is being sold as fast as it can be originated. And we hear about the dislike for holding low rate mortgages, so the only option is to sell. Well, that's what we're going to talk about today and how it's not as simple as it might seem. There's a lot of factors to consider depending on, the needs of your balance sheet. And so we're going to dig into some of those over the next few slides. This quote here is something we often hear. Rates are too low, I can't keep any mortgage production. But really, rates are only half the story. The only headlines you hear recently are talking about the historically low mortgage rates. But as balance sheet managers, you have to ask yourself, how would I fund this asset and how does it fit into my overall balance sheet? And this chart here really lays out what we're talking about when we say you should be focused on balance sheet spread, not nominal asset rate. So if we go back to May 2019, mortgage production was coming in around 4%. And at that time, maybe you were selling less to agencies and holding more on your balance sheet. But were you looking at the overall profitability when you made that decision? If you funded that 4% asset with the FHLBank Boston 3-month classic, you were looking at a day one spread of 130 basis points without considering credit. Now, if we fast forward to today, you could originate a 3% mortgage and fund it with a 7/1 member option, which mitigates a lot of the interest rate risk as you're funding to a matched average life. That equates to 142 basis point spread, which is 12 basis points higher than if you funded using a rolling 3-month rate in 2019. And the second option here is originating a 3% mortgage today, taking on the interest rate risk by rolling 3-month classic advances. That produces a day one spread of 263 basis points, which is 133 basis points more than in May of 2019. You always have to pay attention to what your balance sheet is calling for. So if you're sitting on an insurmountable amount of cash right now and you continue to sell mortgages because you don't like the idea of a 3% mortgage rate, I encourage you to focus on the overall impact to your institution. And as I mentioned, many folks are significantly more asset sensitive than they were last year. So if you can fund a longer duration asset with either deposits or wholesale borrowings while earning a spread higher than historical figures, you solve your interest rate risk dilemma, your excess liquidity problem, and help boost margins. So focus on what your balance sheet needs and determine where the best relative value is that can accomplish what you're looking to do. Now I want to focus on the flexibility that mortgage loans can provide to your balance sheet. If you look at this table, and if we assume you can sell newly originated mortgages at a price of 103 today, that provides a yield to the investor of 2.21% without considering credit. So when you factor in a rate shock 1 year forward, we can see how this might impact pricing. So for example, if rates rise and the investor now requires 50 basis points higher in yield, you're still looking at above par pricing at 100.2. As I mentioned in the previous slide, we really believe that you should be looking at what your balance sheet is calling for. While the 103 priced mortgage seems very attractive because you haven't seen it that high before, what is the plan to deploy that cash after you sell? And, what's the impact to your ALM strategy? By keeping these loans, you're managing margin compression and interest rate risk while retaining very liquid saleable assets. If you're familiar with our mortgage partnership finance program, you probably know that we provide standard pricing for loans up to 24 months. So keep that in mind as you keep some of your mortgage production. And if the climate changes next year or your balance sheet changes, what outlets will you look to when there is a need to sell? The last point I'll make here is, bankers shouldn't be in the business of betting on rates. We're looking at this from a portfolio management perspective and considering all rate environments and how that best fits your institution's needs. So this page is kind of a continuation of the discussion we just had on the prior slide where there's potential for enhancing your earnings. If rates stay stable or drop even further, this scenario plays out really well. For example, if you look at this chart, the green line is looking at cumulative earnings. If you sell today at 102.75 pricing and modeling cash flows, assuming you retain servicing at 25 basis points. However, the blue line is modeling the strategy of holding for 12 months to manage all the things we've previously discussed, and then selling 1 year forward if you no longer want to retain the mortgage production. We're assuming you can sell the loan or the pool of loans at 101 pricing. And so when you model out the cash flows, you see that you're able to beat out earnings compared to if you just sold at origination. Another way to look at this is through a break-even analysis. That's just looking at how long does it take before you recoup your initial investment. For this, we're comparing if you sold today at the assumed price versus if you held the mortgage, assuming the assumptions that are shown on this page here. And as we talked about already, funding costs are very different today compared to where they were a year ago. So when you look at the break-even analysis, you would think that holding a 4% mortgage would have a much shorter break-even point than holding a 3% mortgage with a higher sales price today. But one of the key assumptions is your cost of funding the asset. So if it costs you 2% to fund a 4% asset versus 40 basis points on a 3% asset, that's a huge impact to how this looks. And you can see the assumptions we use, but with those, we show both scenarios have a 14-month break-even point. So if you could hold a 3% asset today and break even in 14 months and your balance sheet calls for it, then why wouldn't you do it? And those are the questions you have to ask. yourselves and discuss internally. And I'm repeating a lot of what I already said in previous slides, but you really have to look at this uh, as far as what parts of the yield curve impact your balance sheet the most, and what does that look like from an NEV and NII perspective. And I'll say this again as well. Low rate assets do not equate to low economic return. How are you funding it? And what does your balance sheet call for? I'm going to talk about a couple of different funding strategies that a lot of our members are looking at right now. First, we're going to start off by looking at the SOFR index advance. As you can see from this chart in comparing the 1-month classic advance versus the 3-month SOFR index advance, since May, there's been a 10 basis point savings on average at the start of the advance. So in a time where all of our members are scrapping for every basis point in savings, 10 basis points is a significant amount and can have a large impact on liability savings. And this is attractive in a number of different ways, whether you're looking to use it for short-term funding needs or you like to manage interest rate risk by funding longer-term assets such as mortgages. This can be a valuable option in your funding needs. The other funding strategy is the member option advance. If you're not familiar with this product, it's a fixed rate advance where you, the member, own the option to put the advance early. And we can offer any term, lockout period, and reset frequency depending on what you're funding and what your needs are. The chart that we're looking at here is the 5/1 member option. So this is a 5-year advance with the first put date at the 1-year mark and every 6 months after that. So with this type of advance, you have the ability to match fund your asset, but hold the option to collapse your funding if rates drop or you don't need the funding anymore. So this product is perfect for mortgage loans. As you've seen recently with the dramatic drop in rates and increased prepayment speeds, holding an option like this can be very valuable. If you look at the chart above, you're looking at the spread between the 5/1 member option advance versus the 5-year classic. As identified by the yellow line, the average is just below 50, meaning with this product, the value of the option equates to an extra 50 basis points in rate. However, with Fed intervention recently and a significant decrease in bond volatility, that spread has come down significantly. Recently, it's been hovering just over 30 basis points. So when you look at funding an asset that has uncertain cash flows, such as mortgages, and you have the ability to fund it with a relatively cheap option, it can be extremely valuable. If that option ends up being in the money a year from now, you're going to be thankful that you can collapse the funding with no prepayment fee. This product has been discussed quite a bit with our members for the reasons I just went over. So this is something to consider as you think about funding your assets. Just to summarize what we discussed today, earnings today versus earnings tomorrow. Does selling your mortgage origination volume make sense if you are already sitting on excess liquidity and experiencing margin pressure? Can you manage future earnings through the retention of mortgages and putting your balance sheet in a position that is built for long-term success? What is your interest rate risk exposure? Are you sensitive to parallel shifts up or down, or are there points on the curve that impact you more than others? And will keeping mortgage production on your books help mitigate some of that risk? Focus on spreads, not rates. This is a very important idea that we can't stress enough. You have to consider all aspects of origination or making an investment. You can't ignore half the equation. So what assets provide the greatest relative value to your balance sheet? And lastly, we talked about some funding options. We went over the savings that the SOFR Index Advance provides compared to our 1-month classic. And then we also talked about how the member option advance provides a relatively cheap option right now that can pay off considerably. That's all for our presentation today. Hopefully you found some value in walking through this case study with me and took away something that your team can discuss as you work through your balance sheet management process in these challenging times. So this recording and PDF version of the slides are available on our website, along with the other case studies, webinars, and articles we've written. If you have any questions, feel free to reach out to me or your relationship manager, and we'd be happy to help out. So thanks again for listening today, and have a great rest of your day.